Hey Smarter Vets, CJ Burnett here, and it's Friday. It's time to do another FAQ Friday. Hopefully we'll have some fun with this one because it's about it's about a subject that's not incredibly fun to talk about. So this question actually is very frequently asked. Recently we had a client ask us this in their very first meeting with us last month, and here it is. So the question is, how much life insurance should I own if I am married with kids? Now, the first thing to ask yourself when it comes to any kind of insurance is, what are you actually protecting? Insurance is designed to take risk that you have inherent in your life, right? And put it on the balance sheet of an insurance company, as opposed to you accepting and absorbing the loss of the risk should something happen. Like auto insurance, if you crash your car, then you don't have to accept the loss of having a wrecked car. You can actually take it and the insurance company will pay to have it fixed or pay for it to be replaced. And so insurance is meant to replace assets. So in this context, right, it's a kind of an odd question with life insurance, because if insurance is to protect something, and now we're talking about life insurance, well, now we're talking about how to protect a life. That sounds odd, at least on the surface, right? And it's kind of interesting how I've always wondered why they don't call it death insurance. Maybe it's just bad marketing. I don't know. But in this context, right, it's an interesting question, because you really have to ask yourself, well, what is the value of a human life? It's an impossible question to answer. The value of human, and it's infinite. It's beyond. There is no value that I can attach to a person's life, right? Because there's different things that make up a person, right? There's different identities, there's different roles, like, a husband, a father, a mentor, a son, and there's all these things that make up a person. It's almost impossible to think about this idea of insuring a life. But obviously there is one piece of a person's life that you can insure that is measurable, and that is the economic impact of their income. And so when you have a lot of kids, like, the more you have to think about, well, how do I insure this? And then there's a bunch of different things out there as far as, like, well, you have to calculate your mortgage and calculate this, and you go through this needs-based analysis is typically what it's called. Now, when you think of the economic impact, though, of a person, it's a very small piece of a person, right? Because there's all these other pieces that make up an individual. The only part that I believe that can be replaced is actually the economic impact of their income. So imagine that the typical person will make millions and millions of dollars over the course of their career, right? So if you started work at 30 and you end work at 65, that's 35 years of earnings. So just even $100,000 of income per year without pay increases means that it's $3.5 million of potential earnings over that 35-year time frame, should they never get pay increases. Now, I don't know anybody who would work in the same place and not get pay increases. Eventually, hopefully you'd say, hey, inflation, right, takes hold of those dollars, and then you need to make more over time. So the economic impact of a person is measurable, especially over their lifetime. And if a premature death occurs, then the loss is effectively all that income they would have earned in the future. So the one thing most people don't know is that there's actually an industry guideline, and the guidelines that the industry uses in order to consider how much is the maximum that somebody could get in life insurance. And you really only need two variables. You need income and you need age. And based on income and age, will typically tell you exactly how much a life insurance company is willing to provide you. So today's answer is right here in this chart. This is the amount of life insurance you can get. Now, obviously, you can take less, right? You can reduce the death benefit, which is the benefit that goes to your heirs in the event that you pass away. You can always reduce that and get less. Like if you're insurable for, say, $3 million and you only want $1 million, you can get $1 million. You can get $2 million. They'll let you play around with that number. And sometimes people will do that because they're trying to figure out from a cost perspective, how much are they willing to spend. Now, when it comes to costs and considering how much you need, that question drives me a little nuts, right? Need, like, how much do you need? Well, if you really think about it, we associate the word need with the loss of the things that we have to pay for in the event that we do pass away, the mortgage, the kids' education, all these things, right? And we try to calculate all these different variables on what to take care of should we die, when really we probably just need to look at age and income and then go, okay, I'm going to replace 10 years of my income or 30 years of my income or whatever amount that the industry will allow you to replace, and whatever amount you're comfortable with doing. A better question other than how much do you need is how much do you want? So how much insurance should you have? Well, that question can be answered with how much of your future earnings do you want to protect for your family in the unfortunate event were to happen where you passed away long before anyone expected. All right, Smarter Vets, I hope this was helpful. Please have a great weekend, and if you have some time over the weekend, check out our financial planning process miniseries. We actually put our entire financial planning process complimentary on the internet for everyone to see. Right, there's 5 videos. You click the link in this post and you get access to it. Hope you have a great weekend.